Hi, everyone. This is Shobit Goel here again. Thank you all for joining on the Friday Eve. I clearly tell that you guys are motivated enough for the global investing, which makes my work a little easy. So let me give an intro about me. I'm a Shobit Goel, a charter holder, and I'm working as a wealth manager at MICS, MI Capital Services. We are based out of Dubai, and currently we are handling $20 million of assets of AUM. We invest globally for our clients. And in our team, we have Mr. Sheetal Soni and Mr. Pratik Toshniwal, who manages this fund. And yeah, I hope this session is really helpful for you. And start the presentation now. I think we got enough people. So before moving on to the or jumping onto our global theme, I want to understand what is investing for us. When we are starting the game of investing, we tend to choose high stocks, high number of return, best return. So this mindset is very short-sighted and very risky. This is very risky because when you try to when you try to chase the high number of risk, you don't assess your risk properly, and you take advice from your family, your friends, your from the internet influencers. So this is not the return we want to achieve in the long term. This should not be your question that what is the highest return I can earn. Think of it as a sprinting or running in the marathon. Sprinting would take you to the 100 or 200 meter, but in the marathon you should start as a runner. Like, think of going slowly but steady in the long term if you want to go far in the process of the wealth creating. Because in when you are chasing high stocks, you might have the 50% return in the 1 year, but in this again next year you can have a 80% loss. So chasing this stock makes you a trader and not an investor. If you want to start your investing journey, if you want to create your wealth, then you need to become a long-term investor, because wealth doesn't create in 1 year. It needs steady returns and consistent return over the longest period of time. Wealth doesn't build over the decades. So your question should be, what is the best return that I can sustain that is consistent over the longest period of time, which keeps me long enough in the game for the compounding to work. Of course, we face some challenges in this process. As I said, we hear advice from friends, families, influencers, and always want to maximize our returns, always trying too hard to get those returns. But investing is not just about chasing the returns, it is about properly assessing your risk. See, investing is a probability game. Some people take few number of bets in large stocks, few number of bets in large stocks, and large number of high number of bets in the small stocks. So it is a probability game which might work, which might not work for some. You need to assess your risk willingness, your risk capacity, your risk tolerance. So you need to manage your risk properly. If you are not able to do it properly, you are not able to chase stocks, then invest in the in the indexes. What I have understood, or what I have learned over the years, that one in years that one could have this simple investing framework. Start with the asset allocation. If you get your asset allocation right, then you are getting 70 to 60% of your 70 to 80% of returns from that asset allocation. You don't need to chase specific stocks and all those things. If you get the asset allocation right, then you are good to go. As in, if you believe this year equity is going to be a winner, or fixed income, or commodities, or any other market, get that top down approach right, get that top call right, macro call right. If it is equity, then think within the equities which market is going to explode. It's developed markets, emerging markets, any specific sector. You don't need to then further analyze that this particular market or this particular market. We have some indexes, developed market indexes, emerging market indexes, which take calls in the 10 to 15 developed markets, 10 to 15 emerging markets, that would make your portfolio enough diversified and can give you moderate returns as per your requirement, as per your goals, or as per your liabilities. If you are trying to, if you are investing for to meet some liabilities. But before we dive in, I would like to ask you all a few questions on your global investing. Like, how do you invest globally? Or you should ask this question to yourself, like, how can I invest globally? What percentage of portfolio should be outside India? And what is my primary goal for global investing? What concerns me most global investing? These are the some questions. What are the returns I'm expecting from the global market? Because Indian market works differently and the global market works differently. If you're trying to chase the same return in the both markets, it could not work. So you need to set your expectations right. You need to have some belief. You need to stay updated about these markets, how these are performing, how geopolitics is working. So you need to ask these questions to yourself. What is your main goal for this investing, either in the home country or in the global market? Now, if we understand what's the current landscape of the global market, you can see this chart. This data shows all the public traded companies in the world market. So you can clearly see US captures the 50%. Rest is followed by China, Europe, Asia, Japan. And you see India is only 4.2% of the global market cap. Global market cap is around $126 trillion, and we are like capturing only less than 5% of the global market cap. So we have the 96% of the market to capture. We have this opportunity. Again, if you go to the investable market, some like most institutional investors like follow this world index, MSCI ECW index. Here also, United States have the 65% exposure, Japan, again followed by Japan, UK, China, and Canada. India here also captures only less than 3% allocation. So it clearly tells the need of the global diversification for us. And it's not just for us Indians. If you every investor across the countries have this home country bias, you can see from this chart around 70 to 80% of the investors invest in their home country. It's not just with Indians. So this clearly tells us there is a need for the global diversification. We need to diversify our portfolio because we have the broader investment choices. We have the currency risk and there's some shocks from the local markets. If I go deep into this, I don't think in India we have a big enough tech company or any AI company or any EV company. We don't have these opportunities in India. We have all these opportunity, all the companies who are doing well in this particular segment in foreign countries. So going globally gives us the opportunity, gives us the exposure that we can't have in our home country. Second, we have studied and we have historically seen that developed markets currencies like USD, Euro, Pound have all appreciated against the INR. So if you are investing in the INR, you might lose on your capital gains also, and you are losing on your currency also. So there is a currency risk also. Second, many people believe in this story of India growth story. Like there is too much optimism that India is going to be a second largest world economy in this economy. We will have a 8% GDP growth till 2047. But I would suggest that don't be a home turf player. Because what if your home turf is not doing well and you are not exposed to the foreign market? Then you basically are taking a concentrated bet. And many people think that India has done 20% CAGR over the last 5 years, so it's going to do the same. Our GDP growth outlook looks the same. But sometimes, first of all, 20% CAGR in the INR terms is very different from the 20% returns of the USD, as we talked just about the currency risk or the currency appreciation of the USD. Second thing, sometimes market doesn't follow the economic outlook. Your GDP growth could be 5-6% on the nominal on the real basis, but your market should no no need to your market to follow the economic growth in short term. These market returns converges to the economic growth in the long term. We can see from this China story, you can see China GDP from 2005 to 2024, between 2005 to 2024 has grew exceptionally well. But see the volatility in their market. The market is not following their GDP growth. And we have the another story to tell. See the Japan story between the same period. Their GDP is very steady, it's very like 1 or 2%, it's very flat line. But see how their market is performing. So even though the Indian economy might have this, people have this perception that outlook is very good, but your market needs to be followed that route. Your other players in the market, the foreign FPI big players in the market needs to believe in that story. Then only that price would follow that outlook that you are anticipating in the economy or in the market. So this clearly tells the need for the global diversification. And if we talk about how the global benchmark have performed in the last 10 years, we can see all world index, MSCI World, ACWI has performed like 10%, more than 10% over 10-year period, because they were mostly exposed to US market, around 60-65% they are exposed to US market. But again, you might say that Asia, Europe index, emerging markets have all given like just 5 to 6% median returns. But these are in the USD. In USD, inflation has been around 2 or 3% over the same period. So again, you are beating the inflation in the USD terms. Also, it doesn't mean that if these markets have performed relatively lower than the US market, they're going to do the same. Because world changes, themes changes, valuation changes. So history is a guide to the future, is not the only guide to the future. Also think relatively. If I tell you that you are getting 10% INR in the Indian market, okay, and if I tell you you are getting 30% USD returns in the US market. So why won't you go to the US market? Why would you want to stick to this, like I am a home player, I want to like take all my bets in India only? So think relatively. Also, market is like a lake. I get this thing, like market is like a lake. It has finite returns. It doesn't have infinite returns. You can't expect small caps, large caps to grow 80 to 90% return CAGR over the 5 or 10 years. Every market gets its time. Market moves in cycles. Basically, your goal is to sell high and buy low. If you see the tech bubble from 1997 to 2003, clearly sees from the 1997 to around mid 2000, it has given us 74% of CAGR. And then again, it has fallen. Goal is to buy here and sell here. Buy around 97, sell at mid 2000. You need to capture those markets. Again, many investors can't get this call right. Of course, we need some confirmation. So most probably you are not going to sell at July 2002 or something. Most probably you are going to buy, at July 2003. When you get some confirmation that the market is reviving, market is doing good, then again see the next 5 to 10 years return. From 2003 to 2008, you clearly see that Nasdaq again has given a 15% CAGR over the 5 or 6 years. So market moves in cycles. There is a up, there is a down, there is a again up. You need to capture those returns. If we go specifically by indexes, if you can see S&P, Nasdaq, respectively, they have given 14 and 18% CAGR over the 10 years. These returns are in their local currency, and Nifty has given just 11% in INR. 11% INR is like 7% in USD, and S&P has given 13%, and Nasdaq has given 18%. So you know how the global indices are working and how Nifty is relatively doing to global indices. Next, many people believe that global investing is just US. We invest in the US market. No. See this graph. These are the performance history, 1 year performance history of Latin America and some emerging European countries, they have given 30-35% return over the last year. So it's not just about the US. World market, this global investing goes beyond India and the US, and you need to capture these markets. See, Australia has given CAGR of 40%, Germany 40, Israel 55, Italy 38. So we can clearly see in the developed market also and in the emerging markets. UAE has given a 40% return in the last year, their indexes. Their stock market is not that big. They might have a few stocks that are trading, but and if you don't get the stocks right, if you had put the money in just the index, you would have earned 40% instead of changing the returns. These are the indexes. Again, I want to talk about this thing that what you pay matters. This is a very good example. It clearly shows how the Indian sector stand against, or Indian companies stand against the global companies. You see, there is this company, Avenue Supermarts, based out of India. Then there is Dino Polska, based out of Poland. See, their last 5 year revenue are same. Their operating margins more or less are same. Net margin, ROIC are same. But see the price to earnings. You are paying 100 times in India and you are paying only 35 times in Poland. And see the returns. 9.7% in India and 20% in the Poland. All the fundamentals are same. Revenue, operating margin, net margin, ROIC, more or less are same. This works in every sector. This is the example of retail sector. And this is, now we can see paints. Again, 5 year CAGR, more or less the same. Operating margins, net margin, ROIC same. But see the valuations. The price you are paying for the same fundamentals is very high in India, could be very high in India. And the same thing, same sector, how it is performing rate in the USA, it's only 30 times. So always think relative in while doing global diversification or while investing globally. How much you are paying here and how much you are paying in other markets. If you're obviously, if you're getting cheaper valuation there, you wanna invest there. So always think relatively. Market is random, relative. Market moves in cycles. Don't be just a home turf player. And there are some myths around global investing, that global investing is only for ultra wealthy people. It's not for retail investors. But this is not the case. There are some platforms, many brokers, many foreign brokers that allow even retail investors to invest as low as $100 or $500. It is complicated and compliance heavy. Obviously, this is the case in India only. We have too many taxations to follow. And if we are going globally, then it creates a view that it's going to be a more complicated, but it's not the case. You just need to file once in a year in your ITR filings. Third, this is more important. People believe that global market move the same way, so diversification doesn't help. It not works like that. It doesn't work like that. Correlations vary. When India is underperforming, Europe might outperform. There is always, in the case of the global market, there is always must be any country, any market that must be in its bull phase. If India is doing bad, India is in its bear phase, any market somewhere in the world would be in its bull phase, and you need to capture that market. You can see by this data, see that global diversification does not diminishes your returns. India just has, in the last 10 years, India has just twice been the best performing country over the last 10 years. So if India has performed poorly, then and in Japan, Canada, US have performed relatively better. Again, market is all relative. This tells us what we call, so I'll conclude here. What about this global diversification? How do you think about this? So market is relative. We have more opportunities in the market to capture more markets, more emerging things to capture. And don't be a home turf player. Market moves in cycles. read about it, be updated about the geopolitics, sell always. Your goal should be to buy low and sell high. You need to capture, you need to get those calls right of the market cycles. Don't chase stocks, even if you had to, even if you had done passive investing, even if you had done invested in an index, then you are good to go. Try to get the asset allocation right. Try to get the asset class as in equity, either fixed income, either commodities. There is a time for every asset class. In 2022, every market in the globally performed poorly, like all were down 10-15% return. So there is a market, there is a time for every asset class. So you need to be well versed, well read about which asset class is doing good or bad. So here comes the efficient frontier of wealth, what we call the looking at the holistic approach of the wealth. See, wealth is not just about choosing the right stocks or right funds. It goes beyond that. What if you have accumulated wealth over the years, but you don't know how to transfer to your heirs, to your next generation? You have generated wealth, but you don't know how to use it, how to spend it well. And what if you have generated wealth, but there were chances that you do not efficiently earn those returns? You did not maximize the net returns you paid out most in the taxes to the government. So this is what at MSS we call at the efficient frontier of wealth, looking at the wealth that is in succession planning and taxes. Now, if we talk about how do we start all this global diversification, global investing that we have talked about, so we have a couple of options available. First, we have the international mutual funds. These are domiciled in India and are denominated in the INR currency. You simply invest just like a normal mutual fund. These are mutual funds also, they are ETFs, and they buy the securities, foreign securities in their fund. But now the problem is that SEBI or RBI has put a industry-wide limit on these mutual fund, like how much they buy foreign securities or how much they not. All these mutual fund AMCs have exceeded their limit, so they are not able to create more securities in the market. So the issue is that supply is fixed, they can't buy more securities, supply is fixed and demand is high. Like investors are creating artificial demand. For mutual funds, they are not accepting fresh investments. And for the ETFs that are traded on the exchange, investors are creating artificial demand among themselves, which creates the problem of the premium risk. Like they are not trading at their fair value. They are trading much like 10 to 15% higher than their normal fair value, which is a risk, because what if these markets again resets to their fair value? Someone who has invested at those 10 to 15% premium would lose money in the market, thinking that these are the growth stocks and these are working fine and they would continue to do the same. But what if he had invested at the top and the market resets to its own fair value? Then he's going to see a loss in its portfolio. So there is, and if you see this, how these Indian mutual funds have performed to their benchmark, see the last bar, equity international funds on average over the 10 years have performed around 7.3%, but the benchmark had given 13.82%. So benchmark is doing better than your fund in which you are investing. It's all because of that supply fixed or artificial demand that these AMCs, these mutual funds are not able to create because of these RBI regulations. Second, anything available in the market apart from the international mutual funds comes under the LRS guidelines. LRS is the liberalized remittance scheme by the RBI. Any product that is denominated in the USD and you are investing in the foreign market would come under LRS. Here you can invest up to $250K per year, which comes around to 2.25 crore rupees in a year. And but there is a TCS, tax credit at source, if you invest more than 10 lakh rupees. Although you can claim this TCS against your TDS liabilities or when you file the ITR, but this is the rule that you need to follow. If you are remitting money outside India, then you can do only $250K per year. This is only for the individual investors. The taxation rules are very simple, just like the normal residents in the normal market. We have the 12.5% for the LTCG, long-term capital gain tax, and 20% for the short-term gain tax. Here, for if we are in when we are investing in the foreign market, foreign stocks, that holding period becomes 2 years rather than 1 year, and the STCG is included in our normal income and as get taxed as existing slab rates. The interesting part is the income. Like it is mentioned here, that taxed as per the existing slab rate. So what happens when you invest in the foreign market and in the foreign stocks or foreign ETFs? Then foreign stocks gives you dividend and withholding taxes. So they charge you taxes, but there are some ETFs available in the market which are called accumulating ETFs, which don't give you any dividend and they reinvest those dividends in the fund itself. So it doesn't create any tax liability on your part, which makes even easier for you to invest globally. You are just getting taxed on your capital claims and nothing more. You don't need to file any other form to get those claim back and all those things. Not just now, if we talk about the companies and the family offices, not just individual investors, these firms also invest globally, and this I quickly go around this. So they also can invest outside. ODI is the overseas direct investment. When the companies want to take control of the foreign equity, they can do that by investing around 400% of their net worth. And if any company, any private company, any public company is looking to invest outside, they can do and not looking for the control, so they can invest 50% of their net worth outside. But there is some distinctions between where the firm is listed or where the firm is not listed. Mostly listed firms can do both ODI and OPI, but the private companies, the partnership firms can only do ODI. They can't do OPI in the mainland, which regulates under the SEBI or RBI. For those companies need to go to the gift city. Now, gift city is a special economic zone, a financial hub that is domiciled in India. It is domiciled in India, but it works other than differently with the SEBI and RBI. So the purpose of creating these gift cities to bring foreign capitals into the Indian market, to help NRIs or foreign investors invest in the India market. This is growing. This is very innovative. Regulator is working very hard. You don't get any tax liabilities here, no GST, no STT. But the problem is it is not for retail investors. This is still for the HNIs or accredited investors who need to invest at least minimum $75,000 in case of PMS and $150K in case of AIF. And we will talk about that also. Many funds are there. First of all, the purpose is bring Indian money into the foreign money into the Indian market. So there are no global outbound funds. Outbound means which funds which are investing Indian money into the global market. We have hardly 2 or 3 funds which have applied for the license, and recently one AMC started doing this, launch their fund, but still they have some minimum requirement of $5,000 and they have around 1 or 2% of fees, which is very high if you look at. But still, Gift City is not for the retail investors who want to invest just 2 or 3 lakh rupees. PMS works like your professional advisor who separately manages your money. Minimum investment is like 50 lakh rupees in mainland India. And if you go to Gift City, the minimum investment is around $75K. They charge you fixed fees. They charge you performance fees also. Some charges both, just not very optimal because you get net returns are very low. And we have seen many PMS in India are not able to beat again their benchmark. They are doing the active investing. They are investing in the stock market, in individual stocks, but still they are not able to beat their benchmark. But the problem again, mostly here is for the retail investors, that there is a barrier entry for the PMS, and for the AIF, it is also work like that. It is a pooled investment, just like your mutual funds. EF is like for HNIs. Again, here is a $150K minimum ticket size, and there is a lock-in period. And tax, their fees are also very high. Like they also charge 1% advisory fees and some 10 to 15% performance fees. But the thing is, for retail investors, there are not many opportunities. Either you go for the international mutual fund investing through mutual funds, through PMS, PIF, there are not many. I guess option left for Indians retail investors is to DIY or directly investing through the foreign brokers. These are some foreign brokers which are globally recognized, IBKR, Saxo, eToro. They are very minimal in their fees, and very you can trade any global stocks, global ETF that you want to trade over there. So question is like for many people could be that I don't know where to invest, which stock to choose. Again, that we talked about earlier, that you don't need to chase stocks and all those things. If you get the enough idea which market is doing, that do passive investing, invest in the indexes or the benchmarks, that would be enough. But these foreign brokers give you access to the global market at very minimal prices. Also, I get this question that if my money is safe with the foreign brokers or not. They are totally safe. They are insured by their regulators in the US or whatever. They are domiciled, like Saxo is domiciled in Singapore. So they are protected. Your assets are protected by the regulators, by the brokers. Even if your broker defaults, this foreign brokers defaults, you are protected by the regulators. Question mostly people or you can say the concern is that how to transfer the money and which asset in which currencies we can invest. So these platforms give you multiple currencies. Like if a stock is trading in the euro currency or JPY currency, you can easily convert your INR currency to USD, or you can directly buy euro stock with your INR money at very minimal rate. So this is the main concern, transferring the money from the INR to USD. Again, under the LRS, individual investor can invest up to $250K, and you can do only bank wire. Mostly these foreign brokers accept only bank wire, and the cost involved is around 1.1%. While depositing the money in the broker account, you would get the same forex fees when you are withdrawing from your cash account with the IBKR. So this cost, many people believe that this cost is very high, and it reduces our net returns, but it's not the case. First of all, this is the I was talking about, that our INR has depreciated like 4% CAGR over the USD for the last 50-60 years. Now, if you are concerned about your currency risk, that you are investing your INR in the USD, but if USD falls, because Trump has given many tweets, he has created many noise in the market, and dollar index hasn't performed very well. It's falling. But if your USD falling, then we have currency hedge ETFs also in the market available. You can see for Japan, if you want to take a exposure in the Japan market, then there is a ETFs available nominated in the JPI, which hedge your USD risk, that downfall risk of the USD currency in relation to the JPY. And these are all the these are just the examples, and we have many more currency hedge ETFs which take care of your currency risk. Now, this is the example I created for some Indian client who was worried about, if I am transferring money from INR to USD, then there is a bank charges, then there is advisory fees, then there is capital gain taxes, and when I am redeeming that money, then again I would be charged I would be charged forex fees of 1.1%. So this is an example of the USD portfolio or the INR portfolio. If you invest 1 lakh rupees each in the USD portfolio and INR portfolio, after 2 years, even after paying all those taxes of bank charges, advisory fees of 1%, or currency appreciation, you would have the 2-year CAGR in the INR terms of 16% if you invest in the USD. Whereas if you see in the INR portfolio, your return would be only just 12.35%. And here there are no bank charges and any other taxes are same. As we talked about, taxes are same, but the returns are higher in the USD because your currency, INR currency, or has depreciated, and USD is a appreciating currency. So there is no risk or no drag down on your portfolio if you are investing outside and paying those taxes and all those things. Now, if we talk about what has worked in the market over the years, we have studied, it's always been the equities, equities, and equities. Now, if we see this chart, if you have invested 100K 20 years ago, we had seen the Nasdaq would have given 1.3 million private equity, then followed by private equity, S&P, gold, REITs, insurance, bonds. Equity has always been the winner. Now, I'm not suggesting that 100% of a capital should be in the equity market only because it has given more returns relatively to the other markets. But ideally, it should be equity should have the higher proportion allocation to your portfolio. We have some clients. I've talked to some people who are 50 or 60 years age. They are also totally invested in equity. So it all depends on your risk profile, your risk willingness, your risk capacity, your risk tolerance. How do you perceive the risk? How much comfortable you are with the risk? But if you see which asset class has done better over the years, over the long-term period, it has always been the equity. And the mutual fund performance that we saw for the Indian market is not only limited to the Indian market. We see the Japan, India, Canada, Mexico. Many active fund managers, even in these markets, have underperformed their respective benchmarks over the 5-year period. 82, 83, 93. Median is like 80 to 90%. Active fund managers have underperformed their respective benchmarks. So again, I'll say don't chase stocks. I'm not even saying that you should not invest totally. You should not invest in stocks totally, but have some major proportion allocation of your portfolio in the indexes. Maybe 10 to 15% allocation could be to your individual stocks. But don't try to chase that. I need to build my portfolio with the single stocks only, individual stocks only. That's the proposition here. And if we talk about the passive market, it's the global ETF market is domiciled in the US. 75% again, 75% market is domiciled in the US. If you want to take on a passive investment into an ETF, it is domiciled in the US, 75%, 16% in US, then 9% in the Asia Pacific. But here the concern is, the ask is, are US ETFs better than these European ETFs? Because US ETFs are charged withholding taxes of 30% and 40% estate tax. Suppose you want to take an exposure in the technology sector and you are investing in a ETF that is domiciled in US. Domicile doesn't mean that they are only investing in the stocks of US companies. They can take an exposure of a European tech company or Indian tech company, but that domicile matters. Because if the domicile is in US, you are getting charged 30% withholding tax and 40% estate tax. Estate tax as in, if total US assets, the total worth of US assets is more than 60K, then you will be charged in any case, in case of your death, you would be charged 40% estate tax just to transfer your wealth that you have accumulated over the period to your next generation. US government would charge for up to 40% if the amount is greater than $60K. And of course, you are getting the charge on dividend tax of 30%. There's a solution. Instead of going to the US market, go to the Europe market. And these are called UCITS. These are the framework under which ETFs are registered, and they have some criteria on how to include securities in their index and all those things. But again, these are just domiciled in Europe market. and they might take exposure in the any stock, any company that they want. But the benefit over of the UCIT ETF to the US ETF is that there is a withholding tax of only 15%. Like in the US market, it was 30%, but for the UCITS, it is only 15%. And there is no estate tax. So if you are investing in the UCITS and you are taking the same exposure that you wanted to take with the US ETFs, you are getting no estate tax and you can simply transfer your wealth to your next generation tax free. So this is the benefit of the UCITS, European domiciled ETFs, which we mainly invest in, the MSCS. So as we talked earlier, follow the top-down approach, follow the markets, like not just the India, not just US, across geographies and many developed markets, every emerging markets, across sectors, across timelines. Not just look at the past 1 year return, take the 5 years return, 10-year return, 20-year valuation, how the relative valuation has worked has been in these markets relatively, how they have performed. If one market is up, the market is down, what's the lag, what's the correlation? So this needs to be your approach. Do this zoom out on your laptop and do all these analysis across geographies, across sectors, and across timelines. See the data I was talking about. Look at the P ratio over the 5 years, 10 years. P ratio just simply tells you the how the valuation is relative to the other markets. So look at the past year's data up to 20 years, not just 1 or 2 years, across developed markets, emerging markets, across sectors. That is what we do at MICS, looking at these datas, USA, India, China, Europe, across sectors. You can clearly see if you want to take, just for an example, you want to take a bet in sector, you can clearly see P is around 12.5% for UA. Financial services, consumer discretionary are relatively cheap within the US market. And if you want to go across the markets, then you can see even Europe has is more cheaper than US in terms of relative valuation in case of consumer discretionary, financial services, energy. So this should be the start. I'm not saying it should be only a decision. It should be start to give you a perspective how the markets are performing relatively. So you can take a approach like this, looking at the P data. And if we are talking about these sectors, what we have historically also seen here, that tech has been the winner. This chart represents the past 20 years of data. Tech has been the winner across sectors. See, the second best is only 729% over this 20 years in on total basis. But tech has accumulated 1500%. It's just the updated data of last day. And if not just the US, the same is applicable even in the global market. These markets and these ETFs are not invested only in the US, but taking exposure in the Europe, India, China. Again, here, tech has been the winner globally. Your portfolio should have, at VMS say पुराने, we say the पुराने चावल, जो चीज चलनी है, चलती आई है, वो चलेगी. Not chalegi, but can give you a history. As I told earlier, that history is a guide. So if that data is saying that tech has been the winner, so you might, and you can allocate some percentage of your portfolio in tech sector, not 100%. I'm not saying going all in one go to only this sector, but it gives you a starting point. How should you look at the data? How should you look at the sector? We can see here that tech has been expensive here. It's trading at a 30p. Might not be the right time or might not be a good strategy to go to the tech sector. But again, it might work, might not work. Who knows? Now, if you look at now talk about the taking or like timing the market. So if you look at the historical data of NASDAQ has given an 18% CAGR over the last 10 years. The proposition here is that many people are afraid of taking the investment decision when the market is falling. But we believe that is the right time that when your mark, you know that Nasdaq 100 or which is invest in the tech stocks and how the tech stocks have performed over the last 10 or 15 years. If not those 5 or 6, 7 stocks that are majorly populated, then other tech stocks would be doing good. But it's the tech sector that has been doing exceptionally well over the last year, 20 years. So if you believe that particular index is going to be going to be winner, so it's when there is a correction in the market, when there is a dip in the market, it's time to go aggressive in that sector, because when it would bounce back, it would give you a major exceptional returns at a compounded levels. So this is the chart that we have prepared, that if you just buy and hold a Nasdaq index, it would give you an 18% return. But if you increase your allocation to the Nasdaq index, 10% increased allocation to your Nasdaq whenever there is a 10% market dip, your return would go to 21.4%. And if you further increase your allocation by 10%, then it would again go to 24%. And it might go up to 33%. Not might up to, it has. We have backtested this data. So if we do 50% increase to our initial allocation of Nasdaq, we have seen that buy and hold strategy of 18% we had given now the 33% approx double returns CAGR over the last 10 years. So whenever there is a dip in the market, try to go aggressive. And when there is a bull market, like every other market is doing more or less same, so be conservative, move your money from one market to the other market. Capital is mobile, people are mobile. So you need to be well diversified. If there is more opportunities, 3 or 4 opportunities in the global market. This again data tells you just same thing. It's not just about the Nasdaq now. We have included all world index. Again, I tell clients these things. If you're not sure about particular market, take the all world index. If US is not working, Japan will. Japan is not working, then UK will. UK is not working, then France will. Any other somewhere in the market again would be in its bull phase, and you would have benefit from that market. So either you go alone with the Nasdaq or you included 50% with the all world index, and you dynamically rebalance your portfolio whenever there is a correction in the market. So you go aggressive, you would see like compounded returns for your portfolio if you just invested, if you had not done the properly rebalance your portfolio. And talking about the tactical allocation, we talked about your strategic allocation. Your portfolio should have 50 to 60, 70, 50 to 70% on those markets that you believe are going to be your safe markets. And for short-term alpha and short-term returns, then you can take tactical allocation in the emerging themes, not just based on the country. This is for the example, you might take Brazil, India, Latin America, you can take South Africa, you can take, but any particular energy sector you can take in Europe. So 20 to 30%, it could be your tactical allocation, but major allocation of your portfolio should be your strategic, that things that have worked well in the past, that are able to capture every market cycle well, the market. So the key lesson is stay put in the game. Don't be a short-term investor. Invest in those securities, invest in those assets that keeps you long enough to be in the game. So in the nutshell, the strategy is simply start with the top-down approach, get your asset allocation right, either stocks, bonds, or any other thing. Choose the market within those stocks, within those bonds, and rebalance it properly, rebalance it timely. Whenever there is a need, whenever there is a time, rebalance it. It's a 3-step process. If you follow this, you would be, believe me, you would able be to generate a massive wealth for yourself if you stay in the game for the long term. Not just this strategy, passive strategy doesn't work for 1 or 2 years. You need to be in the game for around between 5 to 10 years for these to work. So get your asset allocation right, select your fund, securities, and rebalance it timely. Now, we talked about wealth, debt, and taxes earlier. We have understood, hopefully, that how to generate wealth and how to invest in securities, what metrics to look at, and all those things. But it doesn't matter if your net returns are very low. You think that US market has given you a 15-20% returns, but taxes they are very high. So net return would be like 10% or 9%, just in case. So that doesn't make sense. So you need to think the markets which are very tax friendly to the investors. Like UAE is one example. There are no capital gain taxes. There's no personal taxes, but there's no capital gain taxes. It's not also personal taxes, dividend taxes. You need to check if there is a double tax treaty between your country, and the country where you are investing. There are state taxes, but if you plan to transfer those assets to a next generation, so how much the inheritance tax or the estate tax that needs to be paid. So you need to be, again, these are the markets, 0% kits withholding tax for Singapore, Hong Kong, UAE, Malaysia. You can see America charges 30%, which is very high. Switzerland, again, 35. So you need to look at all this data, which market is more tax friendly to us, where we can get the most, maximize our net returns. Look at the capital gain taxes, estate taxes across the market. You need to be aware of the taxes, because if your net return is not worth it, then it doesn't make sense to go beyond your home country to invest in the global market. This is also the main part that people don't plan. Actually, I have talked to many RIAs and investment advisors. They also tag many people doesn't register their will, they don't have the proper succession planning. Like the person has died, and family members don't know where is the asset and who owns what. So the succession planning is very important. The use of wealth concept is very important. How you are going to use that wealth that you have accumulated, how well you are going to spend it. So it needs to be done. It needs to be properly. There needs to be a structured, legal structure. It helps businesses or corporates to continue their businesses effectively. And of course, we face challenges because family dynamics are very different. We don't have the proper professional advice and all those things. But these are the challenges that you need to get rid of. Get a proper professional advice. Get your wills. Get your even if you're investing in these assets, in these investing in with the broker, they have give you option to nominate your nominee or any family member. So choose that option. Plan of obviously, of course, choose will planning. If we see the some examples how these businesses have performed poorly just because of the poor succession planning. See the Malia, Ambani's, like they have built so much like massive business, but their succession planning was very poor, and that's why we saw the rift between Mukesh and Anil Ambani. We have some great examples too, like Tata family, Rockefeller in US, Rothschild, Toyota family. They created trust, foundations. The corporate governance was very strong. They knew where their wealth is parked and how their money is working for them. And every family member has their own responsibility to perform to grow the family business. So it tells. So yeah, succession planning is very important. You need to need to get all these things lined, like wealth, succession planning, and taxes. Case is not what you are thinking. It's keeping the things simple and steady. Keep investing simple and steady. Equity. These are the things you can see the conclusion. It is not all, again, I've said not just equity, but yeah, majorly equity. Barbell personality core satellite approach is like that 50% could be your strategic and 50% could be your tactical allocation. Don't chase stocks majorly invest in the broad-based indexes, which are capturing major market of your country, or in the 10 to 15% could be your individual bets. The world is shrinking. Consider the world as your market. Don't think only your home country is the market and there are enough opportunities. The world is big. There are more opportunities. Control your emotions. The art of detachment is very important, either in investing, either in relationships. So don't be too emotional about your investments. You might take some short-term losses if you feel that is going to be not going to perform very well. So read more, spend more time reading the history than reading the forecast. And yeah, optimize your taxes and play this tax scheme to your advantage. Take care of your taxes as well. Tax succession. Thank you. And this is very important to tell that, as we have talked about many stocks, many ETFs, so we don't recommend any advice to take to invest on those markets. So this is very important. These are some FAQs if you wanna read. Sorry. These are some FAQs that we get that can we invest in ETFs only, or you can invest in stocks also. You can redeem your funds anytime. You can deposit anytime. There is no minimum investment required, but you can't automate your SIPs mostly because you are transferring money outside India and there is a bank fees charge. So it is better to do lump sum investing, and also these brokers, foreign brokers, don't allow you to do SIP. These brokers have the estate planning. As I told you, you can register your will there. You can nominate your family members, and you won't. There's a question about taxes also, that you would be charged both in the both markets, either in US or India. But US don't charge you on your capital gain tax. You need to pay taxes in India only. And even if there are losses on your ETFs, on your foreign ETFs or foreign stocks, then you can offset those capital losses against your capital gains with the Indian stocks and all those things. And yeah, if you have any questions, you want to start global investing, then you can get in touch with me. We have very simplified procedure to get on board you on these broker platforms. This is the process that you can learn. This is our team, Mr. Sheetal Soni, Mr. Pratik Toshnwal, and this is me. And we have these flagship initiatives that we believe as a company that should be, like, people should be aware about the global tax game. People should be aware about their personal finances and all those things. These are the communities, our WhatsApp communities that you can. My screen share or not? Sorry. So these are some our knowledge platforms, Wealth Forum, where we share insights about the market across sectors, across countries. We talk about the M&A, we talk about the corporate finance, and these are some that you can join. And if you have any questions, then please raise your hand, and I will ask, and I will answer your questions. Or you can type it in the chat box also. Wait, I've missed many, I guess. Ashish has asked, like, if my long-term objective is to achieve 15% CAGR over the 20 years, can global investing solve the purpose for me? Yes, we saw about the Nasdaq or the all world indexes. Those indexes performed approx 15 to 18% over the 10 or 20 periods of time horizon. So yes, it's answer your questions. Okay, okay, Sheetal sir has already answered. Have you any data, what is the probability risk of the portfolio or any other valuable points? Currently, I don't have any data plus, but you can get touch with me after this call. Maybe we can discuss this. Can you share the cargo again for the, sure, sure, sir. So these are the links to our WhatsApp group that you can join to be updated about the global markets, what's happening in the global market geopolitics, for the wealth, for the M&A, if you want, just in the corporates. I guess we are done with the questions. If anyone wants to ask, you can please answer, type it in the chat box. Okay, no one is liking typing. So yeah, thank you everyone. Thank you for joining this session. I hope it was wonderful. It was very helpful for you. You were able to get at least uh, one or two things right for the global application. Sorry for any mistakes, and there are many more to come. We would again join, would schedule it for the next month. And if you have any questions, that you can get touch with me after this call. You can follow me on LinkedIn. You can mail me. I'm putting my mail ID here, the chat box, so you can get in touch with me anytime and ask any question about the global investing, and I would love to help you guys. Thanks, Jatin. Thanks, Divya. Thanks, Aruda. Thank you.